Hello, this is Joe Cordell. Welcome to another episode of Cash Counsel. When we last talked, we discussed issues relating to gifts and donations. We talked about asset freezes. All these are topics that are related to estate planning. But really, before you can say that you have a general understanding of how these sort of working parts operate, you've got to understand another option that exists, and that's the option of doing a sale. Now, a sale of an asset can come in a variety of forms, and it can be for various purposes. But you need to think about whether it may be the most effective way for you to move assets from your estate into someone else's name. The effect is that you reduce your estate, of course, for estate tax purposes. Maybe. We'll talk about that more in a minute. You probably create some income tax benefits. Certainly there are some income tax effects in this transfer. There are income effects related to the transfer itself. Was there a gain? Was there a loss? Return of capital? Those sorts of issues. And then, of course, there's the income stream in the future from the asset. If it's not in your name, then, of course, it's in someone else's name, and the income tax implications flow to them. Then, of course, there could be income tax issues in the asset that you take in exchange. Remember, a sale by definition means that you're exchanging assets. You're substituting one asset for another. And depending on what asset you substitute, you could end up in a better or a worse position financially as to income taxes, and of course as to the value of your estate at death. If you took an asset that appreciated at a greater rate than the asset you surrendered, then that probably wouldn't be a good estate planning strategy, though it may be a good business strategy. As a matter of fact, from a business standpoint, we regularly think in those terms. So I'm going to go over what the possibilities are quickly of whenever you do a sale. And there are probably a few additional, but this captures 80 to 90% of the transactions that happen in estate planning when we're thinking about using a sale to reduce income tax liability, gift and estate tax liabilities, and also to deplete your estate. One is a private annuity. Now, I mention a private annuity rather than a commercial annuity because the private annuity is intended to address the situation of those people with unique assets, business owners and others, where they want to use a vehicle or a tool that will allow them to transfer the asset and get a stream of income over the balance of their lives. A commercial annuity, many of you are familiar with. That's when you go to Northwestern Mutual or Metropolitan Life or a variety of other sellers, often of insurance products, who will sell you an annuity, which is a stream of income that would exist for the balance of your life, typically, in exchange for a sum of money on the front end. So there's an actuarial bet that's going on when you're talking about annuities. There's a bet being made by the person who's selling the annuity that you're in fact going to live shorter than what the tables might otherwise predict. And to the extent that you die sooner, then it is a more profitable transaction for the seller of that annuity than if you die later. So there is a bet here based on longevity whenever someone is engaged in the annuity business. On the other hand, if you're the buyer of the annuity, then you're buying a stream of income that's guaranteed to you, typically for life. Now, sometimes you'll have an annuity for a term of years, but more often than not, it's a life annuity, which triggers those actuarial probabilities. But in addition, there are costs associated with the commercial annuity that there may not be with the private annuity. I mean, there are simply policy costs or operational costs, administrative and other, that are going to be built into that commercial policy. The interest rate that's used is more likely to have an internal rate of return of something close to what the market is given that level of risk. Private annuities, there's a little more flexibility on the one hand, and on the other hand, there's less. Here's what I mean. There's more flexibility in the sense that you can choose to structure it in the manner in which you want. Apart from the IRS, a private annuity is an annuity in which you transfer an asset to someone and they say to you, look, I will pay you back, and I'll pay you back in the form of an annuity. So it's not so much like that commercial transaction where you give a check for $10 million in exchange for $500,000 a year for the balance of your life. This is a transaction in which you're transferring an asset, let's call it your business, and you're transferring this corporate stock in exchange for a promise, or it's an annuity, which kind of is in effect a promise. You're exchanging for this promise to pay you X amount of dollars for the balance of your life. So that sounds very flexible, doesn't it? It sounds like it's a transaction between two parties who have the independence to negotiate the terms that they choose. Well, if this were outside the estate planning area, if this were in other contexts, then the IRS might be less vigilant, where these parties are not related. It's an arm's length transaction as opposed to a sham or a thinly disguised gift. Those are phrases that have cropped up in case law involving these transactions. So the IRS, predictably, has moved in and said, look, when you're doing these transactions between related parties, meaning it's not in fact arm's length in the estimate of the IRS, then we're going to prescribe some rules. We're going to develop the interest rates that are used in our tables, and these tables are found in the Internal Revenue Code. And we're also going to prescribe life expectancies. We want you to refer to these. We're going to have rules about valuation, rules about discounts, etc., all in an effort to control the opportunity for manipulation that might otherwise exist in this transaction. You can see how it's fraught with that opportunity. So everywhere from the valuation stage to the calculation stage, the IRS is involved in the process. So let me talk first about the valuation stage. One of the incentives whenever you're transferring less than 100% interest in an asset, one of the incentives is to place controls so that you limit the marketability of those shares of stock. Again, we use a family company example. Let's assume that you own a car dealership, and you want to transfer that to your adult sons, daughters. And yet you're not going to transfer 100% of that interest. So it's a split interest transfer. We talked about this in our last show some. So it's a split interest transfer. And naturally, you would like to avoid, to the extent you could, income taxes as well as estate and gift taxes. But you're driven primarily in this transaction by concerns about estate and gift taxes. So to the extent that you can transfer a whole lot of the value of your dealership, which we'll assume has a value of $15 million, to the extent that you can give away some shares and have those shares constitute very little of the value of that, then you could say that you've avoided gift taxes, perhaps entirely, or at least you've certainly minimized them. You've transferred assets that might otherwise, shares of stock, have had a value of $8 million, and maybe you've declared a valuation for gift purposes or for sale purposes of $2 to $3 million. And you've defended that decision based on the limitations that are included with those shares of stock. If there are limitations relating to the minority interest, which of course these people would have, your children, those are well-established impediments to value, well established. Even at arm's length transactions, when someone is a minority owner in a closely held corporation, then the value of that interest is much less per share than it would be if they were a larger player in that organization, or if it were not a closely held, if it were a stock that were traded on the New York Stock Exchange. So the question becomes not, is there a discount? How much do you discount it? And is there another factor at work here? And if you've had good counsel advising you as to how you structure this, then there are other factors at work. Another factor is that you've restricted the alienation clause, or you have limitations on the ability of that of the recipient, whether they bought or they've received by gift this interest. You have limitations on their ability to transfer it. It's very common in a closely held organization, whether it's a corporation or a partnership, it's very common to have provisions that limit the shareholders' ability to transfer the interest. And these would exist, incidentally, not just in the estate planning context as a sort of contrived limitation. This would exist in the real world in an arm's length transaction. You want to control those with whom you're going to have to work very closely, as is the case in small businesses. So it's routine to have such provisions. So it's not realistic for the IRS to say, we don't want any discount to be permitted for limitations on the transfer of shares of stock, for marketability discounts, minority discounts, etc.